Banking. People give their money to banks. Banks lend that money to other people so they can use it. The banks charge a fee to borrow that money. That fee is called an interest rate. Of course, we know this. That's right. So that the interest rate is the bank's incentive to lend it. Absolutely. The interest rate is the cost of borrowing money. In a typical savings account, the bank will pay you a certain amount to keep your money in the bank because they are lending it out to other people. When interest rates are high, the bank pays you more in your savings account. When interest rates are low, they pay you less in your savings account. So when the bank lends it out to other individuals, it's an interest rate. When the Federal Reserve lends that money out to banks, they do it at a discount rate. The discount rate is like the interest rate for banks to borrow the money. The discount rate is the cost of borrowing money from the Federal Reserve. If the banks receive the money at a low discount rate, it'll charge a low interest rate to people who borrow it. The banks will charge a higher interest rate if they received it at a higher discount rate from the Federal Reserve. So if a bank gets money at 2% discount rate, they might lend it to you and me and to businesses at a 4% interest rate. Of course, they make a 2% profit from lending that money to you. Now, when the Federal Reserve lends money at low discount rates, that means money is cheap. The bank doesn't need your money to lend out as much. In that case, the money it pays you in your savings account is less. Now, how many of us look at our savings accounts now and realize we're not getting much for keeping it there? Does anyone know what some interest rates are that the bank's paying us in savings accounts? Is it even 1%?
It's been so long, it's not even, I haven't even,
yeah.
it's worth looking at.
It's not even worth to open up the piece of paper.
A tenth or 2%.
Yeah, it's very, very low. Very low. Well, there's a reason for that. It's because the Federal Reserve, for a number of years now, has been creating this money, $85 billion a month, and lending it out at almost a 0% discount rate to banks. So a bank can get it at almost zero, charge a low interest rate to us. That means they don't need your money. The bank does not need your money in the savings account because it's getting it for almost nothing from the Federal Reserve. So why would it pay you more to keep it in the bank when it can get it for almost nothing from the Fed? So people in this case are rewarded less for saving their money. When the Federal Reserve prints lots of money, it hurts people saving their money.